Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, January 11th, 2020, and this is the weekly market update. So we had some lively, I wouldn't say lively, but we had some discussion in the comments section last week about inflation. My perspective is I believe that, first of all, we have to define our terms before we can have a conversation. And we have, I think, individuals that I was engaging with think that inflation is price increases, and therefore if they don't see significant price increases, then there's no inflation. I don't define inflation by price increases. Inflation is, in my mind, the definition that Milton Friedman gave many years ago, which is inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by a more rapid increase in the quantity of money than output. So what are we saying? We're saying that the Federal Reserve has the ability to create infinite amounts of money, or currency units, if you will. The US dollar, all central banks are this. They're fiat currencies, they're not backed by anything. As you know, we came off the gold standard in 1971, and that limited the government's ability to spend beyond its means because you couldn't create more money out of thin air to finance debts. Then we were in the midst of the guns and butter situation where there was all kinds of, we were coming out of the legislation in the 60s, Lyndon Johnson's Great Society, where we were going to lift everybody out of poverty. And we were also in the middle of the Vietnam War. And they simply did not have the taxing authority or ability to tax people sufficiently to pay for these things. So we went off the gold standard, and the rest is history. Governments and central banks throughout history, with relation to fiat currencies, have always destroyed their currencies because politicians like to make promises so they can stay in power. That's their only objective. They're not there to help you, to solve problems. They're there to gain power and gain wealth. That's why they're there. So they make all kinds of promises. I mean, you're not going to get elected by going and saying, well, we have to reform all the entitlement programs. That means taxes are going to have to go up. Benefits are going to have to go down. We're going to have to cut the military by 80%. We're going to have to get rid of all these erroneous departments like the Department of Agriculture, the Department of Energy, the Department of Commerce, the Department of Labor. You will never get elected on that platform. So we just print money. Now, the argument was, well, the money printing that was being alleged doesn't lead to any price increases. Well, this is the CPI, this is the Consumer Price Index, going back to before 1950. You can see here, coming out of this recession, right around this is the time when the gold standard was abandoned. You can see that since we've abandoned the gold standard over the last 40 years, we've had incessant price increases over time. Now, we've not had hyperinflation, that's true. That's not good for financial assets. It's not good for the people that control things, the masters of the universe. We haven't needed to have hyperinflation. But we talk about a little bit of inflation is okay, but if it's compounded, 2% is the Fed's current mandate to maintain 2% inflation. But over your working life of 30 years, you could be looking at more than a 60% decline in real purchasing power. That's not destructive. I mean, this is the boiling frog scenario that I've talked about before. And so the particular person I was arguing with said, well, there's no inflation. Look at Japan. Look at, where's the inflation in the United States? My costs are going down. Not according to the CPI, they're not. And if you drag it out a long enough period, this is how the government and the powers that be steal wealth from you. This is why wages have not kept pace. This is why people's standard of living has went down. And people want more of this, more government interference, more statism, more socialism. You have the manifestation of central planning, of Gauss plan type Soviet planning going on at the Federal Reserve. These poobahs, these masters of the universe, these so-called experts, they know what buttons to push and what levers to pull and in what sequence so they get the ultimate result. I've said this before, it's just as ridiculous if they had a committee sitting there of PhDs trying to determine the cost of canned tuna fish in sunflower oil. People would think it was ridiculous. They would make comparisons to Soviet Gauss plan type central planning. But we seem to think that well, the Federal Reserve, they're just like masters of the universe. They really know what they're doing. They have no clue what they're doing. They're nothing but an engine of inflation, of money creation. So I'll go back to the point I made to this particular individual that inflation, if it is always and everywhere a monetary phenomenon, in the sense that it can be produced only by a more rapid increase in the quantity of money, then just because it doesn't manifest itself in hyperinflation, it can manifest itself in other cases. Mark Faber, who's a economist, lives in Thailand, he wrote a book about this, and he kind of makes it akin to a bowl. Think of a bowl on the end of a stick, and you're balancing it, and somebody's pouring water into it, and the water that's being poured into it is money creation. And you have this bowl that you're trying to balance on the stick while somebody's pouring water into this bowl. So as you're moving the stick around trying to keep this bowl level, it's moving around, water's splashing out, but you don't know where it's going to hit, on your left side, your right side, in front of you, and back of you. That's kind of how this works with inflation. They create money, and you don't know exactly where it's going to go. It can go into price increases for goods and services. It can go into, as we've seen over the last 30 or 40 years, the bond market bubble. It can go into stocks. It can go into real estate. We've seen multiple bubbles be created specifically as a result of excess money creation. Let's go back to the first one that I can remember being part of. 98, 99, 2000, the financial tech bubble. Then after that blew up and crashed, the engine of inflation printed money, and we had a housing bubble in 2008. That blew up, crashed again, started printing money again. And here we are in one of the longest bull markets and economic expansions in history. And, somebody says they don't know where the inflation's manifesting. What about this chart? We're at record levels of valuation in the U.S. stock market on a cyclically adjusted PE, price to earnings ratio. We're at such a high level that historically what we are looking at over the next 10 years is annual returns of less than 1% over the next 10 years each year. And that means you're probably going to have a huge drawdown in one of those years. And then somebody tells me they don't know where the inflation manifests itself in price increases. It's in the financial markets. It's in housing prices. It's in all kinds of mal investments in all kinds of industries that shouldn't even exist. Uber, Lyft, Beyond Meat, WeWork, I can keep going on and on and on. So I think it's naive to say, well, I don't see any inflation. It depends how you define the term. You have to be precise in your definitions, and then I think if you define it as an increase in the money supply, then you can determine where that excess money flow is going, into the pockets of the 1%, very wealthy, they get their hands on it, and all kinds of malinvestments and overvaluations in other markets, i.e. the stock market, the bond market. Here's a 40-year bond bubble, bond rally. I mean, how much lower is this going to go? You have the federal government running $1 trillion per year deficits. We've talked about this before, on top of a $23 trillion debt. $23 trillion in debt, adding to it $1 trillion a year in a supposed outstanding, marvelous, super great economy. You can do this as a spreadsheet exercise. If interest rates were where they typically were over the last 30 or 40 years, which is around 5%, then the annual interest cost would be $1 trillion a year. And now, I've talked about this before. You have the baby boomers retiring. They have unrealistic expectations for Social Security and Medicare. Those expectations are liabilities that are anywhere from $100 to $200 trillion, depending on how you want to quantify them. And then people tell me that they think there's going to be deflation. How? They're going to print as much money as they need to print to keep these bubbles afloat and to pay all these obligations that they certainly can't tax people for. So I just wanted to talk about that. That's why I think it's good, and people are going to comment back and they don't agree. Well, if you defined your view of inflation as just CPI prices or the prices at the grocery store, Well, I mean, you're slowly having your wealth be eroded by these people. When you have a sound currency, you see that a man's wages, he's not eroded. If you create wealth, your wealth in the middle class is not eroded. But when they went off the gold standard, there was nothing anchoring it, and they went nuts. Here's your price. This is just consumer prices, which we can have disagreements about how this is calculated. It's probably higher, but based on adjustments they've made to keep it looking at least like this. This is like an airplane taking off. I don't see this changing anytime soon. People want to argue with me on this? Let's move on. Adam Rosenzweig was interviewed on Financial Sense NewsHour. I'll put a link in the show notes. Excellent interview if you're interested in commodities, if you are interested in the shale oil phenomenon and how it's rolling over. What I like about what Rosenzweig said at Goehring and Rozencwajg, you should go to their website. They have outstanding reports that you can read. They come out quarterly, and they have a blog that they probably about every week or every other week they usually update. And they did some excellent work using AI, neural networks, and publicly available data that they were able to get. And they were able to determine that really what a lot of these shale companies have done is really drilled out their best prospects, their tier one, if you will, prospects, the low-hanging fruit. And now they're running out of these options. They're having to move on to less productive areas, and that is why we're seeing a rollover, and it's not going to recover. The current view among many pundits and industry experts and people you see on TV, or even a year ago, was shale oil is going to be so prolific and so productive that the United States is going to be energy independent, and we are going to be the largest exporters, and we are. And shale oil growth is still happening, but guess what? It's decelerating massively. It's rolled over. And very few, if any of these people, have made money. And I think this is a really excellent interview because we are getting to an inflection point in the energy markets. There's another fella that I will put a link to, an interview he did with Marcelo Lopez. He was also on Real Vision. He was also on Macro Voices, I believe. His name's Mark Gordon, and he has been getting a lot of play and a lot of interviews. And he talks about an inflection point we are reaching in the oil markets. He's actually running the Ascent Oil Fund now. He created it. And his view is that we are going from an era of abundance in oil to an era of scarcity. And that the zeitgeist is changing, and that we are going to be looking at very high oil prices, or at least higher oil prices in the mid, even in the short, mid, and long term. That is my thesis also in the mid to longer term. Through the first half of 2020, we have some projects coming on in Brazil, Norway, and Guyana, which I think are going to be ramping up and are going to mask, I think, what's going on in the shale declines. After that, there really are no projects that are coming on, significant projects. And so through depletion, through demand growth, and demand growth is not going away. One of the things that Gordon talks about, Mark Gordon in his interview on Real Vision, was that even with all the hoopla, all of the incentives, all of the subsidies, electric car growth has only displaced about 30,000 barrels a day of oil demand in the world. In a demand scenario of 100 million a day, I mean, come on, people. And people will come on and argue with me that oil's going away. Oil's never going away as a transportation fuel until it runs out or becomes prohibitively expensive to extract. So this has been one of our major ideas, the oil market, the lack of investment, particularly in oil services, and even going down another level, offshore oil services. And we've seen some big moves lately. I've seen some of the offshore oil stocks be up. I mean, I think Valaris, for example, the old Ensco, it was up 20 or 30% in the last week or two. One of the stocks in the portfolio looks like it's finally bottomed out, was up 30% in this week. So something's happening. Money is starting to come back into this industry. I'm seeing it in the Canadian E&Ps that I've been talking about, that are, some of them are cash flowing above 20% real cash flow yields. They're buying back stock. If you follow Eric Nuttall on BNN, if you listen to his interviews or follow him on Twitter, he's been posting more and more companies there having this free cash flow yields. They're paying down debt. They're buying back shares. This is exactly what we expected to see. This is what's starting to happen. And yet we're in the first or second inning. And I think that, you're seeing, we talked about in videos about a month ago, some of your large, big players, Sam Zell, Carl Icahn, Jerry Jones, owner of the Dallas Cowboys. Big money is moving into this depressed sector of oil. So I think we've been talking about it for a while. It's been tedious, I know, but it looks like money's starting to come back. It looks like people are starting to, sentiment may be changing and their views may be changing. But we'll continue to track it. But this is an excellent interview. And my whole idea about this whole shale phenomenon is rolling over. We already know the Eagle Ford and Bakken have rolled over. The only thing that you're looking at for growth is the Permian, and it's rolling over. And Adam Rozencwajg does a real good job of talking about it in this interview, which is free. I'll put a link to it on Financial Sense NewsHour. The Bassoe Analytics, our friends in Norway, I believe, is where they're based, or Denmark, I can't remember. They put out their monthly reports on the market. Jackup report for January 2020. Just read some of this here. Year 2019 ended spectacularly for Jackup fixtures, with the big news being Shelf Drilling's 35-year extension with Saudi Aramco for 4 older Jackups. And it goes on to talk about high activity should continue this year to push utilization over 80%. And we've always said that in the past, that when we see 80% utilization rates, that's typically when we start seeing day rates start climbing. And that's what we're starting to see. We saw, I won't get into it this week, but I think Transocean was talking about some fixtures they had with some of their drill ships. It looks like things are beginning to recover in the submersible and drill ship category, the floater category. But this recovery is happening, folks. And I think as we reach this inflection point, a lot of these major oil companies have not invested in new oil in an extractive industry. You have to do that. And why aren't they doing it? Well, think about it if you're the CEO of one of these companies, especially in Europe, where this whole green ESG movement is really gaining steam. You have a lot of so-called educated people thinking that oil is going to go away. And so you are trying to determine, you're an oil company, you're an energy company. Your reserves are being pumped down every day. If you're not replacing them, you eventually go out of business. But yet you're in this situation where oil is going to be displaced. Oil is going to go away. We're not going to need it anymore. Why would you invest in more oil? Your stock is being divested from pension funds, from insurance companies, from university endowments. Why would you invest in oil? People operate mostly on their own self-interest. And if you're running the CEO of Total or Royal Dutch Petroleum or Exxon or Chevron, I don't know what goes through their minds. They're human beings, but they're there to earn a living. They're there to maximize their stock options and their compensation. That's why they're there. And if the board of directors is full of a bunch of people that are social justice type people, then, if you have a 3 to 5 year contract, ride it out, or, be like BP and get back into wind energy again. I don't really know what discussions happen in those boardrooms. I suspect that they know what I know and what you know, that oil's not going away for decades and that they need to drill for more. But it's a very precarious situation to be in because you're constantly being bombarded by these people, these greens and this whole movement in the West. So we will see what we will see. But I believe that extractive industries have to replace their reserves. And if they don't, they go out of business. That's just a physical fact that can't be legislated away or made to go away by bad feelings or good feelings. I don't see anybody displacing 100 million barrels a day of oil demand in any framework that works for us for the next upcycle in oil. So there's another good article by a guy that writes a blog, and he was talking about, he's in the oil patch in Texas, and he's written quite a bit about this whole shale phenomenon. And this is basically, a lot of this is taken from his blog, and I'll put a link to that. He was referencing a Wall Street Journal article that came out in the last week or so and talked about, and we've talked about this before many times, going back even over a year ago, 200 billion in North American oil and gas debt will mature in the next 4 years, according to the Wall Street Journal. It's actually, if you want to look at total oil company debts, 300 billion if conventional oil company debt is included. So he went through a mathematical exercise, and I've just summarized a little bit. I'll try to explain the rationale, but this is a very interesting exercise that makes the point that I've made all along. He says that American shale oil phenomenon has produced about 12.4 billion barrels of oil in the last decade. That's what that G means. So at current prices of $58 to $59 a barrel for WTI, weighted across all 4 to 5 shale oil basins in America, after royalty, production taxes, property taxes, incremental lift costs, G&A, and interest costs on long-term debt per barrel, the average net back for an American shale oil barrel is about $28 to $30. So after you pay off everything, you're getting back about $30 a barrel. He goes on to say, divide the 29 bucks net back a barrel into $300 billion of debt, and it will require 10 billion more barrels of tight oil to be produced just to pay the debt back. Forget about returns to shareholders, forget about dividends, forget about share buybacks. Just to pay back the debt that's being incurred to produce the 12 billion barrels, you have to produce another 10 million barrels. So to sum it up, it says the shale oil industry now has to produce 80% of what it has already produced the past 10 years just to get out of debt and avoid mayhem. I don't think it's going to happen. And like I've said before, all of the focus on shale provided all of the incremental growth in new supply that we've seen over the last 10 years, basically. We haven't been investing, I say the world, the oil industry has not really been investing heavily enough or sufficiently enough in other conventional sources of oil, i.e. offshore, to replace that what's been extracted. They've been relying on shale. Now shale's running up against many obstacles. They can't get bank financing. They can't issue shares and equity to fund this Red Queen treadmill they're on, because most of the stock prices have collapsed. They're out of money, out of time, and out of hope. As Molly Hatch would say, it looks like self-destruction. And we see this manifesting itself. Here is a chart of the current, or one of the most up-to-date, at least up to week 52 of 2019, of the U.S. nationwide frac spread count. These are the amount of frac spreads that are out, with all those trucks and pipes and sand and frac tanks and all that stuff, fracking these wells. So it's collapsing. Look what's happened. Basically it topped out, the financing ran out, and look what's happened. Now, am I saying that if oil goes up to 70, 80, $100 a barrel that we won't see a resurgence? I'm not saying we won't. I don't know. But what I am saying is currently, look what's happening even in the last week. I mean, you're kind of going down pretty hard, like on a ski jump, and it's just like falling straight down, like gravity grabbed it and is pulling it in. How are you going to grow production when you have 50 to 70% decline rates the first year, and you're not putting enough frac spreads out there, fracking enough new wells in order to make up for the production declines? That's the whole point. Adam Rozencwajg talks about that in that interview that I mentioned earlier. So I really think our time is coming around energy, specifically oil. We've talked about it. We've had some false starts, but I really think, at least in the Actionable Intelligence Alert, a lot of our oil stocks are moving. We have some service. We have a service company in there. We have an oil company. You'll probably be adding some more. And we're not even in the first inning. Into the first inning in this thing. I think we're going to top the old highs eventually down the road. There's not going to be enough oil to supply everything, so price will have to ration. Whether that's $80 a barrel, 100, but I'm talking a year, 18 months. And that's another thing that Mark Gordon talks about is higher oil prices being the catalyst for the next worldwide global economic slowdown. And I agree with that, and that's what I've been saying. I mean, with interest rates so low, with debt so high, I don't see central banks raising rates to regulate the economy, if you will, or try to regulate it. But I do see oil prices. If oil prices go to a certain height, like they were during the last peak of $148 a barrel, that gets to that level, then the economies will start shutting down because the oil price is just too high. So what remains to be seen? Talked about the bond bubble last week. Saw this on Twitter, wanted to share it. U.S. junk bond yields just hit a new post 2014 low at 5.08% of last night, just 25 basis points away from the all-time low. So this is junk debt. This is the garbage, and it's making all-time lows. Why? Because people are desperate for yield. When we do have the next recession, and these zombie companies and these issuers of junk bonds blow up, we are going to be able to harvest our profits from a lot of the things that we're involved with now, and we're going to be able to step in and buy corporate debt at 25 to 30% yields to maturity. You can go on the Federal Reserve, St. Louis Fed site and look up the history of junk bond yields, and you can see what happened during the last economic decline in 2008. These yields in these bonds went up to over 20%. I think they're going to go higher this time, because there's more garbage out there. And you can see that once the Federal Reserve started printing money and buying bonds back, you saw the bonds yields collapse. What happens when bond yields go down? The price of the bond goes up. So not only will you be locking in a yield of 20, 25, or 30%, you will be getting huge capital gains as those interest rates come back down again. And they will. The world's not going to go away and blow up and go away in Mad Max. This is just cyclical. Understanding cycles and volatility is how you create wealth as a speculator. So I wanted to show this because this isn't over yet. I think it goes lower. I have my barometer that I look at, some of these ETFs I look at, and people are still hunting for yield. So I think as long as the Federal Reserve keeps printing money like they are, this can continue. These yields can come down, the stock market can go up. I still think we're going to have, over this year, I think that we're extremely overbought currently in the stock market, but I think we're going to have a melt up. And I think this is going to be part of it. So I wanted to bring that to your attention because we talked about it last week. Finally, Uzbekistan, which is a favorite country of mine. I have a huge investment there via a private equity situation or fund that for specifically investing in Uzbekistan. But what I saw this week was, Uzbekistan has signed contracts on uranium supply to Japan for over $1 billion. The biggest deal was for $636 million. Well, you can read it here. I'll put a link to the article. The trading company Itachu said that it had signed a long-term, large-scale uranium concentrate purchase agreement with a national mining company, and NMMC is the state mining company, I believe, that controls the uranium assets. People don't realize this, but Uzbekistan has probably 52,000 tons of uranium reserves that they can, they're like the 7th largest uranium supplier in the world. What I wanted to note here was this quote: "Through initiatives like this, we remain greatly committed to the stable supply of nuclear fuel to Japan." Why do I have this up here? Why is this being reported? Well, there seems to be some people out in the uranium world that think that Japan has been selling off its uranium. And I'm not sure, maybe different trading houses, some are selling, maybe Tokyo Electric selling some of theirs, but overall these trading companies that process this uranium and supply it to the Japanese nuclear fleet, I think, wouldn't be making this deal if they didn't think that Japan would still be in need of uranium market to supply nuclear reactors for years to come, which is what I believe. This is designed to supply from 2023 to 2030. So I think that puts to rest, at least to my mind, a great deal about the fact that Japan is not going to be a nuclear user of nuclear power, or that it's divesting its nuclear stocks. So just wanted to throw that out there. It's not a guarantee, but I just thought it was interesting. All right, guys, that's it for this week. I want to thank you for tuning in. I want to encourage you to really consider some of the things we've talked about over the last few weeks. I think we are seeing the shift to our side now of the boat: value, contrarian, energy, commodities. I expect to see a recovery in the global economy because of all the money printing, and I think we're going to see a lot of things start going our way. They already have begun. So if you have been considering, if you have some interest, consider taking a subscription to Actionable Intelligence Alert newsletter. We look for vehicles to participate in the things that we talk about in these weekly talks. So I would encourage you to take a look at that if you are interested. So that's it for this week, guys. Appreciate it. We'll talk to you next week.